Hi folks, Scott here, and this is the wrap for Monday, September 9th. So, interesting day today. We powered through the 50-day moving average. That's this blue line. A little bit hard to see because this also had my unfilled gaps showing, and we've got an unfilled gap still remaining up at 1682, but we created one today at 1653.50. So what I thought would be interesting would be to show you, and helpful would be to show you the results of fading gaps after what I call a 50-day moving average up straddle. Meaning we closed above the 50-day moving average after closing below it, hence straddling the 50-day moving average to the upside. Alright, so let me backtest that using Gap Trader, my backtesting tool, which is available on our website. Many of our members have, if you're a do-it-yourself kind of guy. And there you go. So there are the results. Fading gaps after a 50-day moving average up straddle went above the 200-day moving average. 200-day moving average. So we got rid of the weak conditions. So not a real frequent scenario. Maybe a slight bias for gapping down. When I say maybe, you can't really. These are not statistically reliable numbers. You generally want to have at least 30, and the more the better. So maybe a slight bias. We don't know. But odds increase gap fill and show above average returns for gap fill the next day. Now, I'll rerun these numbers for our members in the morning using our MTG stop parameters, but I will tell you, I did just show this in the room for our trading room members, and it favored longs, not shorts. Shorts were okay; they were just average. Longs showed an above average numbers, and I'll share those with our members in the morning, as well as our worksheet, the TGP worksheet. Today's gap play worksheets will show results for fading gaps after an unfilled up gap, which will be very important to consider going into tomorrow as well. I'll also run numbers looking at the fact that today was a 15-day high close. So you look on, I like to use the cash indices. You count them up. This is the highest close, I think, in actually 17 or 18 days. So that's an interesting consideration as well. All right. All right. Let's look at. Let's show what the worksheet showed going into today. This was posted over the weekend, posted it Friday evening before I called it a day, and you can see a gap up occurring between the prior highs and the prior close. It was just a dead neutral strategy, 60% win rate, 1.06 profit factor. So just dead neutral, nothing attractive, doesn't meet my criteria, which are 60 and 1.3. As a reminder, or if you are new, this is a summation or an average of all 8 indices gap guides. So 3 systems apply to 8 indices that are all correlated, the NASDAQ, Russell, S&P, and Dow, both futures and ETFs, and it was just dead neutral, nothing great, nothing bad. In terms of unique day factors, the Monday post-monthly jobs report, that's pretty neutral as well. And then there were several unique patterns: a bullish outside day, false down day, hammer candlestick, and wide spread 7-day. WS7 definitions below. And just glancing, if you look at the white rows here, neutral, maybe slightly attractive, just narrowly missing my criteria for following when fading gaps after a false down day. Hammer candlestick, definitely yes, and WS7, definitely yes, on decent sample sizes. Whoops, 52 and 48 respectively. So I was modestly interested in today's gaps. Let me show you. I primarily trade the S&P, so I pay closest, while I look at all the indices, I pay closest attention to the gap guide for the ES, which is the instrument I trade, and it showed today opening between the open and close of Friday, between 59.25 and 54.50. Again, dead neutral. Looking at ETFs, and unfortunately, I was hoping they'd maybe show a slightly better number. They showed a slightly weaker, actually a much weaker number. Big money loser. PF is profit factor, so it's lost quite a bit of money historically fading in the spider. Now, the reason that the spider will show different numbers than the ES is multifaceted. It can be a number of reasons, I guess is what I'm trying to say. Generally has to do with a certain filter or market condition triggering in the spider but not the ES because of the variance in the closing prices, meaning the difference between where the spider closes, which is based on the 4 p.m. closing price, versus the 4:15 Eastern Time closing price for the futures. So sometimes all it takes is a tick to make a difference, and for whatever reason it made a difference today. So and then the rest of them were just more of the same, just sort of mixed. There were some good ones, but not good enough for me. Here's what I posted my pre-market comments right at 9:20 a.m. Eastern Time. My weekend video wrap that I showed Friday, posted Friday evening, Mondays after a 5-day high close, and a 10-day high close was positive. Up gaps in the DOC zone that are not cowboy setups. That's basically just as defined there. You open in the DOC zone, but not correction. The cowboy gap, you open in the DOC zone, greater correction, lower than the low of the 2 days prior. So it shows a 2-day momentum pattern. That was not the case today. We opened above the low of 2 days prior. So not a cowboy setup. That was a big risk factor when combined with a 50-day moving average historically. Bottom line, neutral to slightly positive overall setups, because the NASDAQ and Russell show some good indices. But the NASDAQ futures were in the problematic DHO zone. There were mostly positives for up gaps, but when you combine it all and the fact that NASDAQ was in a weak zone and the spider showed weak numbers, that was enough for me to pass on. I was on the fence, and I explained to the folks in the room why I don't trust my gut and experience after all these years, 10 years of staring at the charts every single morning, with the exception of occasional vacation. I really thought with the Syrian news out there, we'd likely see gap fill today. But that's why I trust the numbers over my own gut, followed my plan, and saved me a bunch of money today. Let me show you what I mean. So the white dotted line, it's actually two. One is gray and one's white. It's hard to see. One of them is the prior, the gray line is the prior open from Friday. So we opened just underneath that. The fresh brighter white dotted line is today's open, so just underneath Friday's open. So barely in the DOC zone, and it just raced upward, tested the highs. Same with the Russell. NASDAQ opened above its open on Friday, so it was in the DHO zone, which is problematic. And the DOC zone for the YM as well. Passed on, it would have been stopped out because you would have gone short at 1658. Correction, short at 1659 and a quarter, 1659.50. Add 5 points, takes you to 64.50. You would have been stopped out. So good decision. Pat yourself on the back if you follow the probabilities and avoided today's losing trade. Clearly, while this is generally a good zone, it was just barely in the good zone. Market conditions, 3-day patterns, and seasonality overall just weren't strong enough for today. So I passed and avoided a losing setup. Now, real quickly. Nothing showed up in the 15-minute range, guys. First hour guys look good for the high breakout. I'm looking for 55 and 1.1 here. 55 1.1. So I'd call that a half a check. It leans that way. It didn't quite meet my criteria. Clearly favored the high break on the ES. YM right at it. I'd give that a check. NASDAQ check. Russell check. 3 out of 4 favored. Looking at the ETF, spider check. Diamonds lean that way. Q's strong PF. I have to give that a check as well, and a check. It's basically 6 of the 8 met my criteria. 2 of the 8 leaned that way. I'm going to almost always, with rare exception, I can't even think of an exception, going to trade that. So reducing position size in half. I traded the Russell today because the numbers were just stronger overall. See that? And, well, that's the Russell ETF. I trade the Russell futures. And it was just acting more bullish. It already cleared its recent highs. Let me show you a daily chart. Whoops, not. So it was already above when it triggered its prior highs. So it had room to run and test. We even talked about this, testing this 1044 area exactly. Even one member asked me, should I take profits at 2.7 to hold for something further? 2.7 points. And I closed it out, and as I explained I would do, being conservative because the ES wasn't set up as well. But I was long 1038. So I don't know if anyone held it to the 1044 area or not, but it ultimately tagged it, just like we talked about possibly doing. So hopefully some of you caught that. I did not. I was happy with my 27 ticks, or $270 of profit per contract. And I did do the gap gotcha at the end of the day. It's a long trade on an unfilled up gap, and I lost a point, which is a little disappointing, but that's the beautiful thing about the trade. Generally don't lose more than a point or two versus making 2, 3, 4, 5, 6 or more. And there you go. That was my day, and that is the wrap for Monday, September 9th. Have a good one.